Trading and the economy. The invisible engine of the global economy. Every second, billions of dollars move through the world's financial markets: stocks, bonds, currencies, commodities, crypto, and more. This constant flow of transactions is not just speculation, it's the heartbeat of the global economy. When people trade, they move capital from one place to another, set prices for goods and services, signal confidence or fear about the future. From a farmer in India hedging his wheat harvest to an investor in New York buying shares of a solar energy company, every trade contributes to the grand mechanism of economic growth. Trading as the foundation of market economies. Modern economies are built on exchange and competition. Trading allows individuals and organizations to discover prices through trading. The market determines the real time value of assets. Allocate resources efficiently. Capital flows toward companies and sectors where it's most productive. Encourage innovation. Firms with bright ideas attract investors, funding expansion and progress. Promote transparency. Open market reveals information through prices and volumes, guiding decision makers. Without trading, prices would be arbitrary, innovation would slow, and economic growth would stagnate. Price discovery, the market's information system. Price discovery is one of trading's greatest gift to the economy. When millions of traders act independently on their knowledge and expectations, the result is a collective intelligence, a constantly updating signal that tells the world what something is worth right now. Examples: oil prices reveal expectations about global energy demand. Currency values show the confidence in nations' economic policies. Stock prices forecast a company's future earnings. Governments, corporations, and consumers all rely on these market signals to make decisions. In that sense, trading provides the data backbone of capitalism. Liquidity, keeping the economic blood flowing. In biology, blood circulation keeps every organ alive. In economics, liquidity plays that role. Liquidity means assets can be bought or sold quickly without drastically changing their prices. When markets are liquid, businesses can raise money easily and investors can enter or exit positions without chaos. Traders, especially markets maker and institutions, provide this liquidity. They are like the circulatory system that ensures capital keeps moving, funding everything from government projects to startup innovation. Capital formation and economic growth. Trading channels saving into investment. When you buy shares of a company, you are providing it with capital to grow, build factories, hire workers, develop technology. That activity stimulates production, employment, and tax revenue. Consider stock markets fund corporate expansion. A bond market allows governments to finance infrastructure. Commodity markets stabilize prices for producers and consumers. Every trade has ripple effect far beyond the screen. Trading therefore is not just wealth creation for individuals, it's wealth creation for society. Risk management, the economy safety net. The economy is filled with uncertainty, weather, politics, inflation, interest rates. Trading gives participants the ability to transfer or hedge those risks. A farmer can lock in future selling prices for crops, future contracts. An airline can hedge fuel costs to protect against oil prices spike. Investor can use options to limit losses in falling markets. By allowing people to manage risk rather than avoid it, trading encourages productive risk taking, which fuels innovation and growth. The role of traders in stabilizing the market. Contrary to stereotypes, traders are not chaos creators, many act as stabilizers. When prices fall too sharply, value investors buy. When prices soar irrationally, seller steps in to take profits. This constant balancing helps market return to fair value. Speculators, often criticized, actually perform a service by providing liquidity and correcting mispricing. They absorb risk that others don't want, making the system more efficient. Trading and employment. Trading supports millions of jobs worldwide, not just for traders themselves but across industries. Finance and brokerage, analysts, brokers, compliance officers. Technology, programmers who build trading platforms and data systems. Media, financial journalists and researchers. Education, instructors, content creators, and mentors. Regulation, policymakers ensuring fair markets. Even outside finance, the stability and growth produced by trading create opportunities for businesses and workers across all sectors. Globalization and interconnected markets. Trading does not stop at borders. The digital age has created a global financial ecosystem where markets move together like gears in a single machine. A policy change in the US can influence currency values in Asia. Oil prices determined in London can affect transportation cost in Africa. Cryptocurrency markets operate 24 by 7 across continents. This interconnectedness encourages collaboration between nations, but it also requires coordination and responsibility because shocks in one market can quickly ripple through others. The feedback loop between trading and the real economy. Trading and the real economy, factories, job consumptions constantly influence each other. When markets rise, investor confidence grows, lending to more spending and business expansion. When markets fall sharply, fear can slow investment and hiring. Central banks monitor markets to decide interest rate policy. In this sense, markets are both a reflection and a driver of economic health. They don't just mirror reality, they shape it. Trading technology and economic innovation. Advances in trading technology have spilled over into the broader economy. High speed computing and data analytics originated in financial systems. Secure digital transactions paved the way for e commerce and fintech. Blockchain, born from crypto trading, is transforming supply chains and identity systems. The pursuit of faster, safer, and more transparent trading has often accelerated technological progress for everyone. Trading and government policy. Governments can use markets as a tools and indicators. Bond yield influence national debt management. Currency exchange rates affect export competitiveness. Stock indices serve as barometers for public confidence. Healthy, transparent trading environments attract foreign investment. That's why nations strive to build strong regulatory frameworks to balance opportunity with stability. Ethical and sustainable trading. In recent years, trading has taken on a moral dimension. Investors increasingly consider ESG, environmental, social governance factors, before putting money into companies. This shift shows how trading can be a force for positive change. Funding renewable energy projects, penalizing companies that pollute or exploit labor, rewarding transparency and accountability. Through conscious investing, markets can help steer the global economy towards sustainability. Trading during economic crisis. History shows that markets are both victims and healers of crisis. During crisis, panic selling can deepen downturns, but trading also provides the path to recovery. After the 2008 financial crisis, markets helped recapitalize banks and rebuild trust. During the 2020 pandemic, electronic trading allowed economies to function even more when physical commerce stopped. In every era, trading has proven to be a resilient mechanism that adapts, rebuilds, and restores balances. The democratization of trading. Once trading was a privilege of elites and institutions, now thanks to online platforms, anyone with an internet connection can participate. This democratization has profound economic effect. A great inclusion in wealth creation, increased public understanding of finance, empowerment of small investors. However, it also requires education and regulations to protect new participants from misinformation and excessive risk. Challenges and responsibilities. Traders' power also brings responsibility. Speculation can create bubbles, misinformation can trigger panic, unethical manipulation can harm millions. Thus, maintaining fair market requires transparent rules and enforcement. Financial literacy for participants. ethical behavior from institutions and individuals. When managed properly, trading becomes not a source of chaos but a payer of stability and progress. The future of trading and the global economy. The next decades will bring deeper integration between technology and economics. AI and machine learning will enhance forecasting and risk control. Decentralized finance may bypass traditional intermediaries. Green finance will align profit with planet. Trading will remain the pulse of the world economy, faster, smarter, and more interconnected than ever.